This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Welcome back to the TF Metals Report podcast highlights for the week of October 25th, 2021, a week that was destined to end almost identically to last week. But we didn't know that on Monday. There were a lot of things to look at as the week progressed. One of the things we noticed on Monday was a breakout of the downtrend in the price of the TIP ETF. Again, that's an ETF full of Treasury inflation-protected securities and a good measure of real interest rates or projected inflation expectations. TIP, after consolidating for a couple of months, had begun to break out, and that was a topic of discussion on Monday the 25th. The TIP rallied again today, back up 31 cents, 129.07. Those 5-year break-evens at the highest level since 2008, okay? This is all these inflation expectations now coming home to roost, figuring out it's not transitory. As you know, this 128 level, as I show you here on the tip, has been a very important level. It's an important resistance early this year and again in the early part of the summer. And we blasted through there, went from 128 to 131 in the 1st of August in the run-up to chlamydia. But then it's been a downtrend ever since until Friday. And now look, we're rallying back up. The next major level of resistance is going to be about 129.50, okay? Any move above there, and it's going to be even more evidence that this transitory narrative is failing. An eventual move to new highs above 131, and that's really going to be on. Now, again, this isn't the best indicator in the whole world now that the Fed owns such a dramatic part of the overall supply of the tips. But nonetheless, this still gives you some feel for inflation expectations and real rates. The tip now breaking that 2-3 month long downtrend and beginning to turn higher again is something we're really going to want to keep an eye on. On Tuesday, October 26th, one of the things we discussed was what the banks always do. They issue massive amounts of new contracts, sell them to the specs in order to suppress and cap price. Over the period of Friday the 22nd and Monday the 25th, the banks had created, issued, and sold to the specs almost 30,000 brand new COMEX gold contracts. Yep, that's 3 million ounces, nearly 100 metric tons, created from nothing, backed by nothing, and sold to the specs looking for exposure to the gold price. It's how the banks cap price, and it's something we discussed on Tuesday, October 26th. I mentioned the huge surge, 92 metric tons of digital gold created Friday and Monday. But as you can see, this is not the first time this has happened. Ever since we were smashed, I could go back and tell you how much open interest rose in late May, I guess, and or mid-June, whatever. But I just thought I'd show you ever since that breakdown, trying to keep this trend going lower. Look how aggressively the banks have acted every single time prices got near the 200-day moving average. On that big run-up in late July, that day where we slightly closed above the 200-day, July 29th, they added 18,000 new contracts that day. No doubt covered most of them as price then plunged in the week that followed. On September 3rd, BLSBS Day, after being pinned below the 200-day for a week, blasted above it, looking great. They added 8,400 contracts just that day. And, of course, we were smashed on the next market day, September the 7th. How many did they cover back out at a profit on the way down over the weeks that followed? October 13th, just 2 weeks ago, big $35 up day. They added 15,226 new contracts that day. And, of course, remember that? They covered almost all of them. And what was added the next day, the 14th, they covered almost all of them on the 15th in that downdraft. In fact, they may have covered a few more than all of them the next day on the 15th. And then finally, these last 2 days, again, running well up above the 200-day, getting smashed back on Friday, adding 19,600 contracts, running up above and closing above the 200-day yesterday, holding it back by adding another 10,000, and then being smashed back today. Let's check that open interest tomorrow just to see how much they were able to flush back out and cover before the COT report. We didn't have a podcast on Wednesday, October 27th. Instead, it was a written post, kind of like what we do every morning. One of the things we wrote about in the afternoon of Wednesday the 27th was the ongoing capping of price. Again, you notice that theme was all through the week. That capping of price by the banks at the 200-day moving average. That's a critical trend indicator. Get price above the 200-day moving average. Not only does price look positive and sentiment picks up, but the spec trading machines are more apt to buy the dip rather than sell the rally. So the banks are always going to be interested in capping price and keeping it below the 200-day, which, again, we've seen since June. They continued that practice this week. And, again, that theme was going to carry forward all the way through the end of the week. The capping persisted into Thursday. And one of the charts we shared with our TFMR members on Thursday was a 5-day chart of COMEX Gold, showing all the capping, the quick reversals anytime price got near 1810, the driving it back down below 1800 and getting it back towards 1780. And notice on the chart that you see from Thursday, all of the volume spikes are red down volume. Everything else just kind of mild, little rally. But then here come the banks, massive sell orders, smashing price back down, often with the heaviest volume of the day, as you can see with the little arrows pointing to the volume bars at the bottom part of the chart. Again, topic of discussion, Thursday, October 28th. And on Friday, October 29th, price was brutally smashed backward again as the banks use a rally in the dollar index as cover to drive price back down from its 200-day moving average in COMEX Gold and paint not only the weekly charts, but the monthly charts. Now, understand how they've done this. In the 5-day period last Friday through Thursday the 28th, the banks created 30,000 new COMEX Gold contracts, inflating and diluting the total float of contracts by 6%. That allowed them to cap price near $1,800 in that 200-day. And then once they got price going downward today, the specs took it from there. They started dumping those very same contracts that the banks sold them over the past week, allowing the banks to buy those contracts back, cover their shorts, and retire that open interest. Particularly devious today was the London PM Fix, because that PM Fix price was the closing price used to price all of the LBMA month-end options. And so as you see on this chart in front of you, price was smashed overnight and beginning at the COMEX Open all the way up until the 9 o'clock Central Time PM Fix. And those were your lows of the day. Imagine that. So anyway, we'll live to fight again next week. Next week brings not only the November FOMC meeting, but also the latest look at the U.S. jobs market that we call the BLSBS. It's going to be another busy week. We hope to see you at TF Metals Report. There's no greater bargain on the Internet for precious metals information. It's only 50 cents a day. We hope you join us. There's a lot more to these podcasts than just these snippets, and I think you'll learn a lot, not only from what we discuss, but also from the community. Again, TFMetalsReport.com. Have a great weekend, everyone.